So now, having learned almost all of the ratios in financial analysis techniques, let us take this comprehensive example which has balance sheet and an income statement with us. So the objective of this overall exercise would be to find out all ratios that we have discussed till now. So all ratios were divided into four parts, as we have discussed, activity ratios, then we had the liquidity ratios, then we've discussed about the solvency ratios, and finally the profitability ratios. So we'll actually calculate almost all of the ratios which we have discussed earlier in the previous video tutorials. So let's start with the activity ratios. So we had earlier mentioned that activity ratios were nothing but it provides us with how the assets are utilized in the firm. And while we were looking at activity ratios, we had also discussed what is the receivables turnovers and inventory turnovers and payable turnovers, and with that help we were able to find out what was the cash conversion cycle. So first thing first, we'll start with the activity ratio. And within the activity ratio, we earlier started with the accounts receivables turnover. So that's what we'll do now. I'll start with the accounts receivables turnover. Now what is accounts receivables turnovers? We had earlier seen this is annual sales divided by your average receivables. Okay, so here your annual sales is around 400. So let's pick this up, 400. And what are your average receivables? This is where your average receivables are classified as current assets, and you have this 150 and 200 here. So your average receivables will be 150 plus 200 divided by 2. So this comes out to be 400 divided by 175. So this number 400 divided by 175, you can use your calculators. I have this answer ready with me. So this comes out to be 2.28. And with the help of accounts receivables turnovers, we can find the days which are required for collection. And we had defined these collection days as 365 divided by your accounts receivables turnover. So here it would be 365 divided by 2.28, and this comes out to be approximately 160 days. So this is part 1. We have calculated the activity ratio, the first part, which is accounts receivable turnovers and days collection. Now let us move forward and calculate the other set of turnovers and days. The second in line would be the inventory turnovers. And how have we defined inventory turnovers? The formula is what is your cost of goods sold. We have assumed that as inventory goes into the cost of goods sold, that's where this number will come in the numerator, COGS, and in the denominator we'll have the average inventory. And if you look at these 2 years which we have, what is our COGS? Our cost of goods sold is 100 and our inventory is 50 and 70. So I'll use this in our formula. 100 is our COGS and the inventory is 50 and 70. So we'll take an average of these two. So this would be 100 divided by 60, and this comes out to be how much? This should be around 1.67. And if we have to convert this into inventory processing days, the formula would be very simple and similar to the days collection period. This would be 365 divided by your inventory turnovers. So this is 365 divided by 1.67, and if we use our calculators we get this answer as approximately 219 days here. So this is part 2 where we could calculate the inventory turnovers and the inventory processing days. So the third one is basically your accounts payables turnovers. So payable turnover, and how is this defined as? This is defined as not COGS, but this is defined as purchases divided by your average payables. Now we have already discussed why purchases comes into picture. For whatever raw materials that you have purchased and you have taken those on credit, those get recorded as accounts payables. So that's why we will not record COGS in the numerator. We record the purchases here in the numerator to get the fair picture. So go back to our income statement and the balance sheet that we have. How will we find the purchases? Here we have the COGS number, we have the inventory number, we have the beginning inventory number, we have the ending inventory number. So here purchases are not directly mentioned, so we will have to find this number altogether. So let's kind of find this number using our earlier equation which we have learned. This was BA is equal to S plus E. So B plus A is equal to S plus E. This is also called as a base equation. We've earlier seen this equation while we were looking at the inventory and LIFO FIFO. So this equation it starts with the beginning inventory. It says that you have the beginning inventory and you would have added some inventory during the year, and these are basically nothing but purchases. So purchases of the inventory or the raw material, this is the number that we want to actually find out. S is nothing but your cost of goods sold. So we subtract the cost of goods sold, and E is the ending inventory. So if we look at this formula, the only variable that is unknown is A. All other numbers we already know. So the beginning inventory here is 50. Don't know what is the addition. Cost of goods sold was 100 and your ending inventory is 70. So we are able to find out what is A, which is also called as purchases during the year. This would be 170 minus 50. This is equal to 120. So we have the numerator in place and you will use base equation for calculating the same. Now let's move forward and look at how this can be used for calculating the payables turnover. So payables turnover. This is defined as purchases upon the average payables. So we have the purchases as 120. What are the average payable? The average payables will be here in the liabilities side and it is 50 and 100. So this will be 50 plus 100 divided by 2. So that may come out to be 150 divided by 2, that is 75. So your average payables is 50 plus 100 here divided by 2. This is equal to 120 divided by 75 and this would come out to be 1.6. And converting this again into the payable days, so this is nothing but 365 divided by 1.6. So this comes out to be 228 days. So we have fully calculated the inventory turnovers, the receivables turnovers and the payables turnovers, and also have clear understanding of how many number of days it took for each of the processes. So we are in good position to actually calculate the cash conversion cycle. So how do we define this cash conversion cycle? We have seen that it's nothing but cash conversion cycle is nothing but receivables days plus inventory days minus your payable days. Right, so we have done this. So what is receivable days here? Receivable days we have earlier calculated as 160 and your inventory processing days is 219. So 160 plus 219, 160 plus 219, and we subtract the payable days, that is 228. So this comes out to be how much? This comes out to be 151 days. So the cash conversion cycle, or the cash conversion in when expressed in days, is 151 for this current example. So here we have calculated the activity ratios for this company. The other set of ratios which are related to the working capital turnovers and fixed asset turnovers will be discussed now.